Hi everyone, we are Team A and we are pitching Howmet Aerospace. We have our executive summary, which is kind of just where we're going to be heading with things for today.
Alrighty, getting into the company overview. Howmet is the invisible backbone of aviation. What that means is that they vertically integrate key products which are essential for airfare and sell those to different aerospace companies. They have two main revenue streams. The first being their manufacturing and the second being their maintenance, repair, and overhaul. They have four key products that they sell. The first being their engine products. These are products essential for airfare, but specifically with the takeoff process. A good example of this is like their turbine blades. These blades need to be able to withstand heats that far exceed the melting point of metal, while at the same time, they need to be able to withstand extremely high rates of speed. Second, they have their fastening systems, which are little nuts and bolts required for every single plane. Third are their engineered structures, and finally, their forged wheels. Getting into some financial data. Their revenue was $8.2 billion last year, which was an 11% year-over-year increase. While their revenue increased 11%, their operating margin was around 30%. This shows that as revenue increases, they're able to scale. With that money, they're doing exactly what shareholders want to see. In the past 5 years, their net debt to EBITDA ratio has dropped from 3x to 1x. While they paid off $430 million in dividends, and they paid off $2.7 billion in share buybacks. I also want to highlight that their free cash flow conversion rate is 93%, just showing how truly efficient this company is. Finally, I want to emphasize that they're diversified in terms of markets, as the revenue can be broken down into 5 markets, as well as they're diversified in terms of geography, as they operate in 19 different countries, and North America only makes up 57% of their revenue.
Thank you, Michael. Howmet is one of the fastest growing companies in the aerospace and defense sector, and it's only going to continue, with commercial and defense aerospace expected to grow at a 5% CAGR. Boeing and Airbus both have over 12 years worth of backlogs, and Lockheed Martin continues to produce more of the F-35-2 Lightning, and demand is supposed to reach over 2,000 by 2030. This increase in production is critical to their MRO growth, which is expected to reach 53% by 2035. And MRO is huge for them because it's recurring revenue at a very low cost for them, which helps them expand their margins. Along with this, it allows them to then reinvest into one of the fastest growing segments in aerospace and defense, in gas turbines, which grows at a 20% CAGR and is another high margin business for them due to its lower cost and the pricing power that comes with it. When you take a look at how they stand against their peers, you can see their EBITDA margin stands at 29% versus their peers at around only 14 to 19%, demonstrating their operational efficiency as a fast-growing company. Along with this, you can see their ROIC is at 18% and has grown 4% annually over the last 3 years. So overall, you can see that Howmet demonstrates great pricing power and operational efficiency in the sector.
Moving on to our first investment thesis. So Howmet's business model supports structural advantages for the company. So the average lifespan of a plane operates around 20 to 30 years, and that's further enhanced when you factor in aftermarket demand, which is MRO, the maintenance, repair, and overhaul, which can extend the life up to additional 30 years. And with this, they also have an extensive development and certification process that requires FAA approval for each part. So once these parts are approved, any changes will require recertification. This essentially creates high barriers to entry for Howmet and decreases the chances of supplier substitution. Furthermore, as you can see in the bottom right, the current backlog for 2 of their largest customers, Boeing and Airbus, shows that the backlog is significant, which shows revenue visibility for decades. Moving on to our second investment thesis point, the industrial gas turbine segment is well positioned for growth. So in the next 3 to 5 years, gas turbine demand is supposed to increase and double and reach $2 billion in revenue. Furthermore, global power demand is expected to rise at a 13% CAGR over the next decade due to increasing AI and data center expansion. These gas turbines are used to power these data centers and use natural gas, specifically nitrogen oxide, which can reduce emissions up to 40%, which essentially aligns with their ESG initiatives and regulatory trends. Furthermore, Howmet is the largest manufacturer of gas turbine blades in the world. They supply key OEMs like GE Vernova and Mitsubishi Heavy, which allows them to capitalize on infrastructure growth and meet growing energy demand.
Thank you, Sarah. Our first risk is power infrastructure execution, which could push up revenue due to high tariffs or raw material costs. However, with the U.S. data center build-out expecting to surge energy to over 6x by 2035, supporting management's outlook on the gas turbine revenue to grow over 2x over the next 3 years. Second, we have commercial aerospace delays, which could pressure shipment value, although as Max briefly mentioned, Airbus and Boeing's new increased production rates will also provide a stronger value backdrop for Howmet. Third, we have OEM pricing pressure, which could weigh on margins, but we view our ROIC expansion to help offset that as it has grew over 6x within the last 5 years, supporting strong efficiency through high scalability.
Now moving on to the valuation. Overall, we just want to really hit on the theses that Howmet's integral synergy costs, as well as their ability to be operationally efficient, are really the driving factors on why we believe in this company so much, especially within their leadership. We did a sum of parts valuation where we broke down each different segment of the business and did discounted cash flows for each of them. And we were able to build out an overall intrinsic value of $272.90 overall. And we were able to create a large valuation growth for the overall company. Our three main valuations are inline gas turbine growth, which we believe will grow to 30 to 40% year over year with a high cap growth of 43% in 2028. Then we will move on to the fleet modernization of the Trump administration with the correlation that Trump and his administration are looking to completely modernize and overhaul the complete fleet and military Air Force. We believe that Howmet Aerospace is in a supply chain vulnerability that completely expands on their overall revenue growth. And then finally, the CAM and Brunner acquisition completely reevaluate the way that fastening systems and the margin expansion within them changed potential growth and operational efficiencies for their overall EBITDA and revenue growth. And now onto the recommendation.
So lastly, just to wrap things up, we recommend a buy of Howmet Aerospace. We believe that this company has strong potential for margin expansion and continued growth through their gas turbines and durable revenue visibility. However, the market believes that the company is overvalued and that they've already peaked in margin expansion. However, we need you to believe that Howmet deserves a premium valuation and its overall stock is underappreciated, and therefore we recommend a buy with a 17.9% upside.
Thank you guys so much. Thank you.
Go ahead.
You can go ahead.
Yep.
So I mentioned the valuation. The stock is trading at 40 times EBITDA and about 10 times revenues. Those are multiples that you give to AI software companies, not, industrial companies. How do you justify, giving it that high multiple? And if, I've got 17% upside, shouldn't it be a hold instead of a buy?
So we have overall done a lot of different valuation metrics, like we've done EV to EBITDA, we've done some of parts valuation that gave us the best intrinsic value for the company. That was also the most conservative overall to the market. We believe that the 272.90 is an extremely conservative overall assumption for Howmet Aerospace's potential growth. And we do believe that the EBITDA price to EBITDA multiple is just a misconstrued multiple, that they are an enemy of their own growth. This company has had an insane continued annual growth rate of about 23% or just around that, and we have been able to see EPS be beat over the past 16 quarters, revenue be beat 12 out of the past 13 quarters, as well as their EPS adjusted plus rate beat over the past 12 to 13 quarters, and they are continuing to get better every quarter and every year. That will continue to drive higher efficiencies overall throughout the company. Yes, sir.
What could go wrong here?
So with the whole situation of what he's talking about, what could go wrong is the timing. The demand is real. I want to make that apparent. LEAP engines have gone over 28% over this year, which is a new record, ensuring that there is more engine-related components to be had. So the demand is real, and also management has expressed how Howmet is ready for narrow-body deliveries for planes. It's just that only is the capacity, the timing, and how it may affect it. But they also express investments on automation for operatings, just to be more efficient and have the ability to keep up with demand. The demand is real. They're just figuring a way to keep up with it.
Just to follow up on that question, how do you believe that this can all go wrong? Or that how do you believe that the overall valuation could be misconstrued from what we're giving to you?
You're asking me a question?
Yes, sir.
You know, the minute a growth rate, a company that's very highly valued, the minute there are questions about the growth rate, like, you know, GE Vernova starts to do some of this itself,
Yes, sir.
the thing could reprice drastically.
Right. Right. I think kind of to rebuttal that is GE Vernova has insane backlogs of their overall industrial gas turbines up until probably 2035 to 2040. That they are geographically, Howmet Aerospace is in the same local sectors as GE Vernova in about 5 different countries, and is continuing to build in plants and factories that will continue to push GE Vernova to force their capex into them, as well as they're diversifying in the Mitsubishi Heavy in Japan, Siemens Energy in Germany, and they are taking a globalization factor into their multiples, and so the growth is, no matter what, going to be real.
And just to add on to his point is that Howmet has over 1,300 patents, like worldwide. So the amount of the capital that they own, it's very difficult to do what they do. So because they have so much patents, and because when I was researching the different products they have, no one else can really do what they do. What they do is very difficult to emulate, and the switching cost between going to them versus one of their competitors is so high that it's so much easier for their customers to stick with Howmet, and that's why those backlogs are so big.
I think another thing to point out is when you also asked about the overvaluation. When you take a look, when we talk about their competitors, that 29.5% EBIT I think is also huge, because most people in the industry truly only sit around 12 to 14%. So it's pretty exceptional what Howmet's been able to do, especially when it's projected to grow to 31.5% this year, another 2% increase from the 3% year increase just last year, along with being able to reduce their net debt to EBIT down all the way to 1, where most competitors sit at around 2 to 2.5. Demonstrates that they have a lot of ability, especially if struggles come in the near term, that they are well equipped to combat it. They've also reinvested a lot of money into AI to help with their efficiency throughout the market.
Did you prepare a forecast income statement?
No, but we provided, I did prepare, if you move over to our sum of parts valuation, I did create the entire projected cash flows for the next 5 years, and then as well as the terminal value on top of that. These are the valuation cases. There we go. Where we were able to find the revenue and the growth percentages, as well as their EBIT margins and EBIT flat, so that we were able to take their notepad and really expand on it to show how much the company can potentially grow within their overall efficiencies.
Okay. So, you did, these are going out to 2030, right?
These are going out to 2030 with the 10K pulling from for all this data right here.
And you assume 20% growth in fasteners, and then 6% growth
for commercial transportation, because we read in the commercial statement day, or the commercial transportation statement day, where Howmet Aerospace called out that in 2026 Q1 that the bottom line will bottom out for the company, and that they will be able to see higher demand with less tariff base coming onto them, and more shipping within the U.S. being necessary, especially within the conflicts that are happening this year and in the following years with higher conflict rates.
And just to add, so they're the aluminum-based wheels, like forged wheels, and they are 4x times the biggest competitor that make aluminum-based wheels. And aluminum-based wheels are 30% of the forged wheels market, like global. So that market is continuing to grow because first, for economic reasons, and second, for ESG reasons. So I actually think it's a very conservative estimate because if you put in like the economic reasons and the ESG reasons, I firmly believe that the forged wheels are going to continue to grow.
And yeah, just to kind of wrap everything up, essentially Howmet has a very diverse product portfolio, and because of that, as well as the growth engines, we do believe that the valuation it's being given is being mispriced, and we do believe that the premium is justified due to all of these growth metrics, and we also believe that these segments have continued growth. They've shown growth over the past 5 years and continue to project increasing growth, therefore justifying the premium valuation since they are not reliant on any one segment.
And also, I just want to just touch upon that a little bit as you talk about growth drivers, how there's a new expected one, the gas turbines, and how management from previously have reiterated that is coming up, and as it's only 11% of revenue 2025, one of the fastest growing sectors in the stream, becoming a new driver, expected to pull over 2x in revenue over the next 3 years, just basically making it almost a quarter of revenue potentially soon due to all the AI data build out.
Is that time?
Yeah.
Hey, thank you guys so much for your time.